change the information. Still the same information. That is more for trade, but most of that computer trading is based on trading information. Volume, trading volume. It's not based on accounting information. So, that's a different question.
All right, I will come
Think
back
about
to you.
it. So, there are lots of issues around information, and you can think about what they are, but it's got to be more focused. It's too general a topic. So pick something, a particular type of information that you think is not updated frequently now, no matter how the market is.
Okay, thank you.
Professor, so my company just released its 10K.
Yeah.
But they provided no 2024 guidance. Like, should I?
Yes, right.
It doesn't.
That is irrelevant. Yeah. It's nice if you have it because you're getting some sense of what the year one numbers are going to be.
It's fine now.
So how do we measure the amortization for acquisitions? How do you measure the amortization?
It doesn't matter because it's not tax deductible anyway. There's no life. It's impaired goodwill. Goodwill gets impaired if you actually
add it to our
acquisition. Just drop it up there.
Got it.
Because what will show up is impairment of past acquisitions. Will show up as impairment of goodwill if there is any, but might not be there.
Correct.
Hiking in Pennsylvania without water, is that what you did? Yeah. Only for equity risk premium. But for debt, you can't do that. Right? Just the default spread of the country you're incorporated. Doesn't matter. You're just doomed by wherever you're incorporated. So if you're a Greek company, it doesn't matter if you're in Germany, they'll still treat you like a Greek company. Yeah. Yeah. Okay, folks. I hope you got my email about the quiz this morning. And I said, in fact, in capital letters, I said, please read, because I know you're not reading my emails now. At least you're browsing through them and you get bored after the first paragraph. But this is the final document with all the rules. I'm sorry about the confusion because in a sense, it said, well, it said this in the notes. This is the final set of rules. Are there any questions about the logistics for the quiz? So when is the email tells you, right? And what do the past quizzes look like? So have you seen a multiple choice past quiz? Where did you see a multiple choice question on the past quiz? maybe one question. So the past quizzes are any direction that kind of tells you what the next quiz is going to look like, right? I mean, it's the same person writing the quizzes. I can't reinvent myself. So if there are no multiple choice questions on past quizzes, there'll be no multiple choice questions on this one. It'll show up as four one-sided pages with one question on each page. Use the rest of the page to write your answer. And you might not believe this, but I'm looking for reasons to give you credit, not reasons to take credit away. So what I'd like you to do is show me your work. Because if you just put an answer there and it's the wrong one, it's all or nothing, because I can't give you credit for things I can't see. So if you can do it a little without, scribbling all over the place, a little sequentially so I can see your thought process, it'll help me if you made a mistake somewhere in step 3 or step 4 to give you partial credit. Okay? So Wednesday, 3:30 to 4, first 30 minutes of class, everybody will be in this room. I considered getting another room, but we're just at that tipping point where I think we can keep in this room. So basically, when you come in on Wednesday, find a seat, one seat away, and I'm being specific for a reason, from the next person. Because if you leave 2 seats, then it's going to be a problem. We won't have enough seats, but if you leave 1 seat between you and the next person, we'll be able to fit everybody with enough room. The reason the extra seat is nice is with open book, open notes, you have stuff to spread out. It'll give you some room to spread out, okay? So no other questions? So we will cover everything through cash flows, no growth questions. So the first 15 minutes of class today will be what's on the quiz. And after that, we'll be talking about growth. You can shut off, not listen, but it'll be in the second quiz. But you have time to catch up anyway, right? So today's class is really about how growth affects numbers. So I'd like somebody to be my calculator while we do this, okay? And here's why. Before we do that, though, let's try to guess. So let's say you have a company. I've said LinkedIn, but it can be any company. The revenues are 200 million right now. And you decide to put in a 30% compounded annual growth rate for the next 10 years. I just want you to guess based on your frame of reference. How much do you think 200 million will become by year 10 if you put in 30% growth every year? So I'll go through the numbers. Just go with your gut. I'm not going to hold you accountable for it. So here are the choices. It'll be 500 million, 1 billion, 2 billion, 3 billion, 4 billion. Let's make a choice and then we'll actually do the calculation. How much do you think 200 million will become if you put in 30% growth every year? What do you think? 2 billion? Anybody would think 500 million? No? Anybody think 4 billion? Okay, let's say, in fact, if you have a calculator, you have a computer open, can you take 200 million and compound it at 30% for 10 years and tell me what you come up with? Just think, how much did you come up with? 2.6 to 2.7 billion, right? The reason I bring that up is we underestimate how much compounding does over time. We think it's only 30% growth rate. What can it do? And just to show you what can happen, if I double that growth rate from 30 to 60%, you got 2.6 billion, 2.7 billion, 30% growth. What do you think is going to happen if I use 60%? Will it just double the number as well? No, it's going to go up 5 times as much. What I'm trying to do is make you a little more cautious when you're valuing a company about getting carried away. You have a high growth company, you're going to be tempted to say, I'm going to use 75% growth for the next 5 years, the next 10 years. Check your number at the end of the 10th year to see what you get as revenues, because it can be a scary looking number if you put in a 75% growth rate. Growth rates, especially if they're compounded, can very quickly become immense numbers. Yesterday, I heard somebody was talking about NVIDIA, and they said the company can grow 100% a year for the next 10 years. Right? I don't think this person has ever compounded a number. 100% a year means you double every year. You double your numbers, NVIDIA will now have to own the entire AI space, not just the chip, everything else in AI. Okay? But people throw numbers out because they're looking at last year's growth rate, just extrapolate from that. Last year, NVIDIA did grow 100%. It's an amazing year. But if you assume that for the next 10 years, NVIDIA would have to own the world. And that's basically the challenge you face with really high growth rates. So we're going to get to historical growth and when you can use it and when you cannot. But I want you to remember the magnitude of what's going to happen when you do this. One final question about growth rates. People talk about growth in earnings and they don't specify earnings, what measure of earnings. So I want you to think about a typical company and think about growth rates at different line items, right? So the very top, you got revenues. You can compute the historical growth rate in revenues. Then you have operating income. A little further down, you can compute a growth rate in operating income. Then you get further down, you get a growth rate in net income. And you go even further down, you can get a growth rate in earnings per share. Which one of those four growth rates do you think is going to give you the lowest number? And which one's going to give the highest number for a typical company? Revenue and earnings per share. Explain to me why, as you go from revenue to operating income, your growth rates will tend to go up. You have fixed costs, exactly. And as you go from operating income to net income will grow faster because you have interest expense, which is a fixed cost. And you go from net income to earnings per share, what's causing the deviation? Companies increasingly in the US are buying back shares. That's been the way they return cash. And if you buy back shares, those shares get removed from the books. The share count actually decreases over time. The reason I bring that up is for many of your companies, you can look up a growth rate in earnings per share that analysts are projecting. It won't even specify growth rate, it just say consensus growth rate. But analysts project growth rates primarily in earnings per share. So when you see an 18% growth from analysts, they're projecting growth in earnings per share. Don't take that 18% growth and apply it to your revenues. You're almost guaranteed to overvalue your company. So let's start to get more specific about growth rates because the growth rates can be divergent depending on which metric you're focused on. So we have a lot on our plate. Let's start by going back and completing the last couple of components of our free cash flow discussion. So we talked about free cash flow to the firm. So what do we do to get free cash flow to the firm? We start with after-tax operating income. Remind me again, what tax rate do we use to get to after-tax operating income? Is it that absolute? With cost of debt, we always use the marginal, right? There it's all. But with operating income, we had nuance, which is we start with the effective, whether it's a couple of years or 5 years, and then over time we move to the marginal because otherwise we're completely ignoring the tax benefit from deferring taxes. So we start with the after-tax operating income. Then to get to cash flow, what's the next step? We subtract out reinvestment. Reinvestment, what? Everything. Net CapEx, which might be the traditional accounting, but we also capitalize R&D, we might capitalize other costs. And if you do acquisitions, that goes into reinvestment as well. So after-tax operating income minus reinvestment is free cash flow to the firm. It's a pre-debt cash flow because operating income is before interest expenses, and we're not factoring in any debt repayments or debt issuances in that cash flow. So today I want to start with a discussion of free cash flow to equity. And as we go through free cash flow to equity, think about what we're trying to do differently here as opposed to free cash flow to the firm. We're trying to compute cash flows after debt payments. Now, for the longest time, I remember when I wrote my first book on valuation, when people talked about free cash flow to equity, they said, oh, that's easy, just dividends. For the longest time, people used dividends as their measure of free cash flow to equity, arguing, hey, that's what I'm getting as a stockholder. Why would you want to compute this abstraction called free cash flow to equity? So if you look at dividend discount models, they're based entirely on dividends. Dividends are what companies actually pay out. Free cash flows to equity are what they could pay out, potential dividends. If companies pay out what they can afford to, the two models will give you the same answer, right? I could just use dividends. But we know conclusively that companies don't pay out what they can afford to in dividends. How do we know? With companies that pay out less, you see a buildup in cash balance. Google has 110 billion in cash. That's almost a guarantee that they've been underpaying dividends. They don't even pay dividends. Maybe after this Gemini fiasco, they should pay huge dividends and just get the cash out of the company. But basically, they don't pay dividends and they could afford to, huge amounts. Conversely, can some companies pay out more than they can afford to in dividends? How do they do that? They either use past cash balances or and this is the strangest phenomenon, they actually issue equity to pay out dividends. A lot of REITs do this. because they're so stuck with paying dividends that they want to continue to pay dividends, and they issue new equity to pay dividends. So many companies pay dividends that don't match up to free cash flow equity. That's why we try to compute the potential dividend. So I'm going to start by talking about how we compute that potential dividend. But to do this, I'm first going to remove from the discussion things I've seen analysts use as potential dividends. I've seen some analysts discount earnings. And the argument is a company can pay out its earnings as dividends. Is that true? Does it have to? Is there a law that says I have to reinvest? Okay, now we're getting closer. If you decide not to reinvest and you say, I'm okay with not reinvesting, you can pay out your earnings as dividends. But then what growth rate should I use in my valuation? Negative or a zero growth rate. If you're doing that, then I'm okay. But if you take the earnings and pay it out as dividends and you put in a growth rate, I have a problem with that. You can add back the depreciation and pay it. But in a sense, if your depreciation and CapEx offset, which can happen for a mature company, what you get as a cash inflow from depreciation goes out as a cash outflow. But when people use earnings, you can contest them, say earnings are not cash flows, but you can also contest them by saying, if I pay my entire earnings out as dividends, how the heck am I going to grow as a company? So when you look at the potential dividends, you have to look at the cash left over after the reinvestment you need to sustain the growth you're giving this company. And that's actually a relatively simple computation to make because it's in the statement of cash flows. I mean, remember, what's the end game? Why do accountants have a statement of cash flows? What is it that they're trying to explain? It's broken into three parts, right? There's operating cash flows. We have net income, working capital, and non-cash charges. You have investing cash flows where they have capital expenditures, cash acquisitions, other investments. And they have financing cash flows, which includes dividends, buybacks to equity, as well as debt payments and debt issuances. But the bottom line of the statement of cash flows is try to explain why the cash balance changed that year. That's in fact the end game. That's not why we're looking at the statement of cash flows. We're looking at the same statement of cash flows to try to answer a different question. How much cash is left over in this company after they've met every conceivable need? So as I go through each line item, if you remember what's in a statement of cash flows, I want you to think about where in a statement of cash flows you'd find it. I want to start with net income. Why? Because this is free cash flow equity. I'm going to start with an equity measure of income. Is that in the statement of cash flows, net income? It usually starts the operating. So if you look at the very top of the operating section of the cash flows, it'll start with net income. Take that net income. Then I want to subtract out CapEx and add back depreciation. Is that in the statement of cash flows? Depreciation and non-cash charges should be in the operating section. CapEx should be in the investing section. So we're still in the statement of cash flows. I want to subtract, add or subtract out changes in non-cash working capital. What is that? Receivables, inventory. That should be in the statement of cash flows, right in the operating. So we're staying in the statement of cash flows still. I then want to see whether there were any new debt issuances or debt repayments. Go to the financing section. Those items should be there. They're all right there. You don't have to leave. So this is what makes free cash flow equity so simple to compute is you stay with one statement. You should be able to get every single one of those items, at least for the most recent year. So you take all these items, net income minus net CapEx, minus change in working capital, plus debt issuances minus debt repayments, you come up with free cash flow equity. Could that number be negative? Yeah. You could start with a loss, in which case you're already in the hole. That could make it negative. Or you can start with a profit. And what makes it negative? If you have a company that's money making, why would the free cash flow equity be negative? Then CapEx, it's not just the CapEx is huge. The CapEx is high relative to the depreciation, right? If you have a company with both high CapEx and high depreciation, it offsets. But if CapEx is high relative to depreciation, or they had a huge working capital change, an increase, or they had a big debt repayment come due, your free cash flow equity can be negative. And if your free cash flow equity is negative, how much should you pay out as dividends? It shouldn't be, but companies do. This is why we compute free cash flow equity, to make ourselves make an honest assessment of what this company could pay out in the future. So if I were doing a statement of cash flows, you can get it. Every single item in the state is in the statement of cash flows. The one thing to remember about the statement of cash flows, and this is actually helpful, but if you're not thinking straight, you can reverse it, is the cash flow sign is in front of the cash flow. So when you look at CapEx, it'll be a minus in front of it. If you look at working capital, if it says a minus, it means it's a cash outflow. Your working capital went up. A plus means it's a cash inflow. So you don't even have to change the signs. Just keep all the cash flows as they are in the statement of cash flows. And what you will get as a bottom line is your free cash flow equity. There's a typo here. See this minus here? That should be an equal. There's another way in which I can get free cash flow equity, which is work up in the other direction. I can take the dividends and buybacks that got paid out last year. And then I can add to it the stock, if I've changed, if my cash balance went up, I can add the cash balance. So if you take Google last year, they had no dividends. They had no buybacks. 0 plus 0. You're saying this is terrible. But their cash balance went up by 27 billion. Your free cash flow equity is going to be 27 billion. They issued no stock. So if you have a statement of cash flows, you can either work down, and I like to work down from the top down, or you can work from the dividends and buybacks and build up. And either way, you can get a sense of how much could my company have paid out in the most recent year in free cash flow equity. So any questions generically about free cash flow equity? You had a question? Well, that's a good question. Remember, R&D, whether you capitalize it or it's an operating expense from an equity investor's standpoint, is going to be a cash outflow, right? So the question about do I capitalize R&D becomes almost irrelevant, because if I capitalize R&D, my net income is going to get pushed up, but so is my reinvestment. So the net effect on free cash flow equity is going to be exactly the same, whether I capitalize R&D or not. Okay? That's why when you do free cash flow equity, you can be much more casual about things like R&D and leases, is because it's an after debt, after CapEx cash flow. Any other questions? Now, at the start of this class, I introduced this notion of a corporate life cycle. And I said, this is a useful way of thinking about why free cash flows equity and other components change over the life of a company. So you think about a startup, right? Young company. And many of you are valuing young companies, you will tend to see losses. Not a bad company, just where it is in the life cycle. You'll tend to see high reinvestment. Why? Because this company wants to grow. You take a loss and you put in a big reinvestment, your free cash flow equity is going to be negative. It's going to be a big negative number. In fact, it's called cash burn. In many young companies, this is a feature of the company. They're burning through cash. Where are they getting the cash though? Somebody's supplying them with the cash, right? Venture capitalists, people investing in the company. And they're burning through it as fast as you supply. Does that bother the people who are supplying the capital? It should. But why do they keep supplying it? Hope springs eternal. Say, one of these days, they might go public and it'll be the next $90 billion company. As companies mature, your losses will start to turn to profits. You're still a high growth company, but because you're a high growth company, you're continuing to reinvest large amounts. So your income will turn positive well before your free cash flow equity will turn positive. So there's going to be a lag between when you start to make money and when you turn cash flow positive. Again, this is the feature of growing up as a company. As you mature as a company, your earnings are going to start to level off. I think that's bad news, but your reinvestment is also going to start to level off because your growth ambitions have dropped off. Your free cash flow equity will turn positive. And as you get even more mature as a company, you're at maximum dividend potential. So sometimes observing what a company does gives you some insight as to where in the life cycle it thinks it is. What's a big name company that recently announced a dividend? Meta, right? That's revealing because it tells you what Meta thinks about its own future. It's not a bad thing to admit that you're maturing as a company, but that was the message I got, which is, hey, we're a growth company, but we're approaching middle age. We don't want to be middle age, but it's healthy to recognize where you're in the life cycle. So when you see companies initiate dividends for the first time, usually it's a sign that they're aging as companies. Doesn't make it a bad company. It's a very different type of company. And they want a different type of investor. Do you see what I mean by different type of investor? If you're a young growth company, what kind of investor do you want? Basically, long timer or forget about longer. You don't want dividends. You want price appreciation, right? You want growth. And that's all you care about. And Meta is sending a message out saying, if you're that kind of investor, we don't want you. We'd prefer somebody who settles for lower growth and accepts cash flows as a substitute for that higher growth. A different investor base. And as you go through the life cycle, you see. And when you go into decline, your earnings will start to go down, right? But your reinvestment will actually turn negative. What does that mean? What are you doing when you're going into decline? You're divesting assets. So you're actually getting cash inflow. So your free cash flow equity can actually be higher than your net income as you approach liquidation. If you take a look at net income and free cash flow equity for your company, you can very quickly start to map out where it is in the life cycle. And part of your job in valuation is to estimate what will happen to it as you look at over the next 5 years and the next 10 years. So just to give you a sense of what this dynamic looks like, I picked one of my favorite dynamic companies. And I've been valuing Tesla since 2013. I've seen it go from being money losing to money making over this period. And we can debate how much money it makes. So you can see the green line is the losses. The company never made a profit till it got to 2020. And then it exploded out in 2021. And you can graph out 2022 and 2023. 2022 was amazing. 2023 was much flatter, but it's now a money-making company. Okay. Its free cash flow is equity. We're more negative than its net income, which makes sense, right? If you're a growth company, you're building the new plant in Shanghai, it costs you money. So the red is the free cash flow equity. Notice that the profits turned positive in 2020, but the free cash flow equity is actually pretty close to zero, which for Tesla was a win. That's the first time in their history they had zero free cash flow equity rather than having to raise capital. And in 2021 and 2022, you saw free cash flow equity show up lower than the net income because they're still reinvesting money. They still have growth potential. But if you graph out these high growth companies over time, you're going to see something like this show up. So if you're valuing a Google or a Facebook, if you have capital like you, go back and get the data right from the beginning and graph out both net income and free cash flow equity, and you're going to see this phenomenon play out. I told you earlier that companies don't pay out what they can afford to. So one of the things I do at the start of every year is I look back at the most recent year, look at what companies paid out in dividends. I also look at their free cash flow. So if you look across, let's take Africa and the Middle East. In 2023, they had $230 billion in free cash flow equity. They paid out about $191 billion in dividends and buybacks. So they held back cash. So as a percentage of their free cash flow equity, they paid out about 75–80% of the free cash flow equity. But take a look at the US. The US had $563 billion. 563.7 billion in free cash flow equity. US companies collectively in dividends and buybacks paid out 1.6 trillion in cash flows. Remember when we said about companies as they approach maturity and go into decline, what happens? Their free cash flow equity starts to exceed, the dividends and buybacks. As countries hit their peak growth and they start to decline, you're going to see what. So this is not good news for the US as an economy because it suggests that you're on the wrong side of the life cycle, if countries have life cycles. If you're a high growth country, you should expect to see dividends and buybacks actually hold back below the free cash flow equity because there's growth in the future. You want to hold back the cash. And you're going to start to see that play out across the regions. One final point about free cash flow equity. If you look at that extended calculation of free cash flow equity, think of the individual line items you need. You need to project. So let's say you're projecting out free cash flow equity in the future. First, you got to project out net income, right? Then you got to project out CapEx, then depreciation, working capital, debt repaid, debt issuances, 6 line items. It can be exhausting. So I'll give you a shortcut that'll work if you're willing to make an assumption. The assumption you need to make is that this company, whichever company you're looking at, is going to finance a portion of its reinvestment from debt, and it's going to stay with that number. 40% from this day on will come from debt, 60% from equity. If your debt ratio is stable, you can actually compute the free cash flow equity a little more simply. You start with net income, you still have to project it out, But you take the net capex and you look at only the percentage of that net capex you have to come up with as an equity investor. Remember, when you're an equity investor and you're computing free cash flow to equity, all you care about is how much do I have to come up with? If 40% of the net capex comes from debt, you say the remaining 60% comes from me as an equity investor. Same thing with change in working capital. Rather than count the entire working capital, you count only the equity portion. You're going to end up with a free cash flow to equity that is roughly the same as doing the full calculation if your debt ratio stays stable over time. So I'm going to take you back to the late 1990s when I computed a free cash flow to equity for Disney as a company. Okay? I could update this, the mechanics would stay the same. The company had made $1.533 billion in net income. The net capex was 1,746. The depreciation was 1,034. Take out the per share. That's about 612 million in net capex. So they reinvest a lot. And the change in working capital was about 477 million. And at least in the late 90s, their debt ratio was pretty stable. It was about 24% debt, 76% equity. I assumed that they would stay with that debt mix. Here's what I did to compute the free cash flow to equity. I started with the 1.533 billion. Subtracted out only the 76% that came from equity, saying that's all I care about as an equity investor. And the same thing with working capital. My free cash flow to equity with the shortcut was 704 million. It would have been very close if I'd done the long calculation. But in that year, their dividends were 345 million. If I'd used a dividend discount model to value Disney, I'd have undervalued the company because I'm focusing on that lower number. So the reason we compute free cash flows to equity is we don't trust managers. We don't trust managers to pay out what they can afford to. And we replace the actual dividends and buybacks with what they could have paid out as dividends. I used a 24% debt ratio. If I'd used more debt in funding the company, so let's say I'd used a 40% debt ratio. Holding all else constant, what's going to happen to my free cash flow to equity? So if I have more of my reinvestment come from debt, less from equity, will it go down or go up? Because remember, as an equity investor, all you care about is how much of the reinvestment comes from equity. So I'm using more debt and less equity. I'll be reinvesting less as an equity investor, right? Yeah. Oh, but if I'm reinvesting less as an equity investor, won't the free cash flow to equity go up? So let's say I replace 24 by 40%, right? So I'd be getting 60% of 612. That'll be 300 and something million instead of 465. And it'll be 300 million instead of 360 million. So each of those numbers is going to be smaller if I have less coming from equity, more from debt. So I'm subtracting out less reinvestment. Won't the free cash flow to equity be higher? Yeah. So as I raise my debt ratio, my free cash flows to equity will become higher. This looks magical. So I want to make my equity more valuable. All I need to do is keep raising my debt ratio. Can it be this easy? Do companies just get more valuable when you use more debt? Yeah. Not the cost of debt. I'm going to give you another try. What's the other? If I'm using free cash flow to equity, what's my debt? No, I'm going to give you a third try. It's free cash flow to equity, so I want cost of equity. So my cost of and tell me why will it go up? But what is it that we do in our calculations that raise? We use a levered beta, right? This is exactly why I pushed you down the levered beta path, is to take away this free lunch. You want to raise debt, I'm going to give you the higher free cash flow to equity. But then I'm going to say, you know what? Your cost of equity went up to 18% because you used more debt. The net effect can be positive, it can be neutral, it can be negative. That's why you can't say debt increases my value of equity, because it really depends on the company. Yeah. So that's my beta for Disney at different debt ratios. So when my free cash flow to equity is going up as I go from 0 to 10 to 20 to 30 to 40 to 50, my beta is also rising because I'm using a levered beta. And the net effect is what drives that relationship between leverage and value. So I'm going to close with that question, because let's see how much you remember of your corporate finance class. I'm going to read out a series of choices of what will happen when you have this plus and minus from debt. The first is increasing leverage will increase value because the cash flow effects will dominate the discount rate effects. You think that's true? If that were the case, then what should every company have as a debt ratio? 99.99% debt, 0.1% equity. So that can't be true. Maybe increasing leverage will decrease value because the risk effect will always dominate the discount rate effect. If that were the case, then what should every company do? Have no debt, right? What about this? That increasing leverage will not affect value because the two effects will exactly offset each other. In corporate finance, do you read or learn about the Miller-Modigliani theorem? What does the Miller-Modigliani theorem say? That the value of a business is independent of its financial leverage. If you believe Miller-Modigliani, it sees, in fact, what will happen is as you change your debt ratio, whatever you get as benefits will exactly offset the cost. It's another way of arriving at Miller-Modigliani is through this approach. I think A, B, and C are all unrealistic. A and B because they lead you to end solutions. And C because it's this nice solution, but it assumes there's no default risk and no bankruptcy costs and no taxes. Not the world we live in. In the real world, any of those things can happen for any given company. For your company, maybe the value will go up because the benefits exceed the cost. For another company in your group, value will go down as the. That's why there is no easy answer on should I borrow more money? It depends on your company and whether the benefits exceed the cost. So any questions on free cash flow to equity, when you might use it as opposed to free cash flow to the firm? I mean, we'll come back and close up that loose end, but clearly it's a different way of thinking about cash flows. It's a cash flow to equity investors. It's after debt payments. Let's talk about growth. And yes.
How much do you think that's spent on CapEx? Sure. Are you looking at what's ideal, or are you just trying to look at what management has done so far?
You're estimating the growth rate for this. Everything, take ownership of all your inputs, right? So by the time you get to the CapEx, you've already assumed a growth in your company. That's all you can do, right? In a sense, this is not about what management tells you. In fact, at the start of the class, what company are you doing again? Discover. And the problem is they're not giving guidance for 2024. Some managers tell you what they think will happen the next year, and we often use that as a way of forecasting year one. It makes our life simpler, but it can also be dangerous because managers can be patently unrealistic about their forecast. So when you value a company, you estimate a growth rate for your company. And all I'm going to ask you to do is estimate a reinvestment that's consistent with your growth rate, right? Because if you do that, at least you're being internally consistent and you're not creating these valuations that are going to blow up on you because the two numbers pull in opposite directions. So let's talk about growth. Now, the point, the kind of subtext that growth can be good, bad, or neutral is something you're going to see me come back to over and over again. The reason I say that is often analysts think of growth as a good thing. It's amazing. Grow faster, grow at a higher rate. And that might or might not be a good thing for value for your company. So let's talk about the trade-off on growth. The good side of growth is it makes small numbers into big numbers, right? That's basically it. It takes your small revenues, the 200 million revenues, it makes them $8 billion. The bad side of growth is to get that growth, I have to reinvest. If the good side exceeds the bad side, growth adds value. If the good side and the bad side offset each other, growth will do nothing for value. And if the bad side exceeds the good side, growth can actually destroy value. The faster you grow, you become a less valuable company. So part of the exercise of what we're going to try to do is create this consistency between growth and reinvestment. Ask, in my company, is growth creating value, destroying value, or doing nothing for value? So let's look at the ways in which you can estimate growth. And I'll start with the simplest and perhaps the most intuitive way. I didn't ask the question, but I'm going to assume that every person in this class has picked a company already. If you haven't, don't tell me. I don't want to know, because at this stage, I will assume you picked a company. And part of your job is to try to forecast future growth, right? What's the most logical place to start? Look at the past, right? So we're going to start with that. We're going to look at the past and look to see what we can learn from the past as a precursor to predicting the future. So we'll start with that. That's called a historical growth rate. What's the second thing you do when you want to estimate the growth for your company? You go on Google search, it says, anybody estimated a growth for my company? And then even if you're not going to use it, it's nice to know, right? that, Jim Cramer thinks my company will grow at 25% a year, and he knows more than I do, so I'll use 25%. So the second way to get growth is look outwards, analysts, experts, managers giving you a growth rate. That's why we like guidance, because managers say, I know what the growth rate is next year, even if they don't, and you use that as your growth rate for next year. There's a third way to think about growth, which is growth doesn't come from history, it doesn't come from analysts, it comes from what you do as a company. Remember we said to grow, you have to reinvest. If you take a look at your company and it's been reinvesting very little for the last decade, including R&D, including acquisitions, you should probably be a little more cautious about giving it a high growth rate for the future, because if you haven't been reinvesting, you don't have a good platform for growth. How much are you reinvesting becomes one of the questions you're going to have to address in terms of growth. The second is, it matters where you reinvest. If you can reinvest well, you should be able to grow faster than if you reinvest badly. So in the third approach, I'm going to tie how much you grow with how much you reinvest and how well you reinvest. So in summary, you can look at the past, historical growth. You can look at outsiders' estimates of growth, analysts, managers, experts, or you can try to look at what the company does and use that as a clue for forecasting future growth. Yes. Absolutely. Everything is part, in a sense, this is part of the problem with estimating growth. Everything matters. Your company matters, the management matters, the industry. I mean, if you have a company that's in the AI space, are you going to be more upbeat about forecasting growth? Yes, because the space. If you're looking at an airline company, you're going to be a little more pessimistic about growth? Absolutely. So you're going to, and that's why, when you look at the company numbers, I also report the industry averages, not because I'm trying to force you to the average, but at least you need to be aware I'm in a fast growing industry or a slow growth, because that will play a role in what growth rate you give your company. So let's start with historical growth. Okay. We think historical growth is a fact, right? So when I say, what's your growth in earnings over the last 5 years? I haven't told you operating income or net income or earnings per share. Already you can see different metrics can give you different growth rates. Different time periods can give you different growth rates. So when we talk about historical growth, we have to ask the question, how was it estimated? There are, in fact, people who make these incredibly complex regression models to get historical growth, not future growth. I think it's completely pointless, but they're trying to get a growth rate from the past. You can compute an average growth rate over the last 5 years, but that average growth rate can be an arithmetic average where you add up 5 numbers and divide by 5, or a compounded average. Very different numbers, as you will see. No, and even if you get the growth rate right over that period, the question is, can I use it for the future? You're saying, why shouldn't I be able to? Because your company might have been a tiny company 5 years ago, and it's become a much bigger company now. You see why that's going to matter, right? When you have $10 million in revenues, growing 100% a year is not a big deal. But if you've done that 5 years in a row, you're now at 500 million. I have to be more cautious about what kind of growth rate I can give the company. So let's start by looking at past growth and why you can get very different numbers for different metrics. Okay. This was Motorola in 1999. I estimated historical growth in revenues, EBITDA, EBIT. I actually, in my book, had net income and earnings per share as well, but you're going to see the pattern very quickly, even with these 3 measures. So I computed an arithmetic average growth rate, which is just take the 5 numbers, add them up, and divide by 5. So each year I've computed the growth rate. I've also computed a geometric average. You know how you compute the geometric average? What do you do to get a geometric average as opposed to an arithmetic average? Take the ending number, take the starting number. You can ignore the middle numbers, and then raise it to the power 1/5. So basically, it's a compounded average. Ending number, starting number. So all it needs is the starting and ending numbers. So when I look at revenue growth, my arithmetic average is 7.08%. My geometric average is 6.82%. Not a big deal, right? They look pretty similar. As I go to EBITDA, my arithmetic average is 10.89%. My geometric average is 5.39%. The difference is widening. As I go to EBIT, it's 42.45% arithmetic average, about 4.31% geometric average. It's becoming even wider. If I'd added the net income and the earnings per share, you can see that you'd see the difference get even wider. And this is simple statistical or math reason for it. Under what conditions will the two be equal, what has to be true about the growth rate every year? If I want the same geometric and arithmetic average, yeah, if I have 8% growth every year, there's no change, then my arithmetic and geometric averages will converge. The more standard deviation there is in my growth rates, the greater the difference between arithmetic and geometric averages. It's nothing to do with finance, it's pure statistics. That's why when you do revenues, you can be a little more casual about how you compute growth rates than when you do earnings. You can see the difference here. So the more volatile your growth rates are on a year-to-year basis, the more critical it is that you use compounded averages, not arithmetic averages. Okay. So it's a very simple statistical point, but the reason I bring it up is often when you go to Yahoo Finance, it'll give you a growth rate and earnings for the last 5 years. They're very casual about how they computed the growth rate. My advice is don't trust anybody else's computation of the growth rate. This takes 1 minute for you to do. Do the compounded average yourself. It's safer, you know exactly how you computed it, and you're not subject to the kind of fiascos that come about because I used an arithmetic average. So arithmetic averages and geometric averages are going to be different, and they're different. Trust the geometric average. It's a much better measure of what's actually happening to your earnings over time. Okay. Second, and this is again a mechanical issue, think of how we compute growth rates. You have $1 in earnings, it goes to $1.50. You have a 50% growth rate, right? How did I get the 50%? I take the change in earnings and divide by the earnings last year. You say, what's the big deal? Let's say you have a company that has negative earnings that become positive earnings. This is a long time ago. Time Warner had earnings per share of -5 cents, and the next year, their earnings per share became 25 cents. First, is this a good, are they moving in the right direction or the wrong direction? -5 cents to +25 cents, that's a good year, right? If I compute a growth rate using the standard definition, what would my growth rate be in 1997? Does everybody get that? It'll be -600%. You think that makes no sense. This is what happens when you let Excel calculate things. It'll say -600%. You know why it's -600%, right? It's because my denominator is negative. So, you know, people then try to fix this. One way is to replace the negative, to take the earnings per share last year and replace with earnings per share this year, which will give you a positive number in the denominator, and say the growth rate is 120%. Or just take the negative, make it a positive, and say it's +600%. The reality is when your earnings go from negative to positive, your growth rate becomes not meaningful. So if you have a company with a history of losing money in intermediate periods, your growth rates will get messed up by those negative years because you set up the Excel spreadsheet to compute growth rates. You get the wrong sign on the growth rates as you go from negative to positive. Go to compounded average growth rates again. You're not doing year-by-year numbers, and hope that your starting number is not a negative number, because then you're screwed. You can't do any kind of growth rate if that's the case. Okay. So when you see people dealing with negative earnings, I've seen people do contortions, acrobatics to get this number to make some sense. So, one is to use the higher of the two numbers in the denominator. The other is to use the absolute value in the denominator. My advice is, if this happens, just don't even compute a growth rate. After all, you're doing this to forecast the future, and none of these numbers is a good predictor of the future other than to get a sense of them gone from negative to positive. That's good news, but I have to start from scratch. One final point about growth rate, and this is especially true for those of you who are working with small companies that have become big over the last few years. Now, you heard of Callaway Golf? Right? 1990s, the company took off because it did one product that became an incredibly popular product called the Big Bertha. It's a golf club. I don't play golf. I don't see this allure of paying hundreds of dollars for a golf club. But golf is one of those sports where bad players are convinced that if they just had the right equipment, they'd all be Tiger Woods. So they spend insane amounts of money on better clubs and better balls and pay more for golf courses. If I do that, then I'm going to be a scratch golfer. And the Big Bertha took off, and you can see how much it took off. So this was in 1996. I was valuing Callaway Golf. Their net income had gone from 1.8 million to 122.3 million. And their compounded annual growth rate over that 5-year period was 102%. So it's not an arithmetic average, it's actually a compounded average. If I just decided, I mean, let's say I put ChatGPT to work here, it's a value companies, and I said, just use past growth rates as your predictor of the future. If I put 102% growth rate on the 122 million for the next 5 years, want to guess what the end profits would look like? 4.1 billion. In other words, all of us, even if we don't play golf, would have to have a big Bertha in our closet, maybe as a weapon, could sell it as a second use. That's the only way you can get to 4.1 billion. What does that mean? When you're valuing a company like Callaway Golf, if you're in 1996, you look at the history of great growth, it can still be a great company, but you cannot keep forecasting those really astronomical growth rates from the past because you're now it's called, basically it's a scaling up problem. You have a much bigger company, you got to get more conservative over time, even if nothing changes in the company because you're building off a much bigger base. So if you look at my NVIDIA valuation, people complain your growth rates are decreasing as you go through time. Absolutely. Because my revenues are going from 40 billion to 400 billion, I cannot keep growing at 50% a year because a 50% growth rate on 400 billion would be $200 billion in additional revenues in 1 year. Okay, how great you're as a company. That's going to be really tough to pull off. So scaling up is hard to do, something to keep in mind as you forecast future growth for your company. You're making your company bigger, your growth rates almost have to come down to reflect that size. Before I leave you on historical growth, I know a lot of people in the value companies trust the past. In fact, they're almost addicted to the past. You take out their historical data, they're lost. They don't even know what to do. Implicit there is the assumption that if you know past growth, you can predict future growth. Okay. So about almost 60 years ago, this guy called IMD Little, that was his name, he's a British who came over here for a PhD in economics. And he decided to test a very simple proposition. How good is past growth at predicting future growth? So if you are constructing a test to do this, anybody have any ideas on how you would see if past growth was a good predictor of future growth? What did you? He basically took in 1960, you had to have low-tech solutions because you didn't have the kind of, the tools what you have. He took 10 years of data. He broke it into 2 5-year periods, 1951 through 55 and 56 through 60. He computed the growth rate for every company for both time periods. So if you have 1,000 companies in your sample, you have a growth rate in the first 5 years, a growth rate in the second 5 years. And then he ran a correlation across those 2 growth rates. So past growth is a good predictor of future growth. What kind of correlation should you see? High positive. If you get 1, you don't even need a person to value a company, right? You just take past growth, you're done. I won't tell you what he found as a correlation, but I'll give you the title of his thesis. It's at higgledy-piggledy growth. What do you think he found as a correlation? He found 0, which is the worst possible one, right? If you get -1, you're still great because all you do is you take the past growth and you take the exact opposite. You use for every company high past. He found no correlation. That's, I think, a lesson to keep in mind. Looking at past growth makes us feel more comfortable. We feel like we're dealing in facts. But the truth is, the future is still an estimate, and past growth is not a great predictor of future growth. 0 correlation. He was shocked because there are some companies where you can, and there's always a selection bias, right? When you take the Mag 7, you're saying there is correlation here, but I picked the Mag 7. If you look across stocks, it's amazing how quickly you see growth rates go back and forth. It's not even that they're reverse, but they go all over the place. Okay? So when you look at past growth, it's perfectly okay to look at it, but don't make that the basis for all you do in the future because the circumstances might have changed. The market might be different. Now, the competition might be different, and it's your job to make your best assessment for the future, and historical growth is not going to do that. Yes? Because I think it's a good place to start, right? Because when let's say you decide to give your company 20% growth, and its historical growth rate has been 3% in revenues. You know the first question I'm going to ask you, right? What's changed? What's different about the company? Does it have a new product? Is it entering a new market? So when you estimate a future growth that's different from the past, you're implicitly in your story, you're telling me something has changed in my company in one direction or the other. I'd like to know what it is. So we look at past growth to frame our story. And if your story is my company is pretty much the same company it's been in the past, you can use past growth, but it's based on your story. So I think it's good to know it, even if it's not your forecast for the future, because it helps you in deciding what the story for your company is. Let's talk about the second way you can estimate growth. Outsource it. You know why consultants exist, right? Because you don't want to make estimates. You hire McKinsey to make your estimates for you. That way, if it gets screwed up, you blame McKinsey if something goes wrong. And in valuation, you see the same phenomenon play out. Analysts looking outward say, tell me what the growth rate is, using that growth rate and blaming that person when the valuation goes wrong. So when you look at the different sources of growth, at least, and this used to be true just in the US, but it's across the world. When you value a company, I can almost guarantee you that if your company is mid-cap or larger cap, there are other people estimating growth for your company. Some of those people spend their entire lives tracking this company, and your first reaction is going to be, it's the first time I've done a valuation. This is the first time I've looked at the company. They must know more than I do. It's a natural place to start. So one of the things I'd like to talk about is, what do equity research analysts do when they look at a company, and how do they come up with growth rates? And more critically, if you're valuing a company, is there value in knowing what analysts are projecting as growth for your company? Because if there is, then we should be looking at that growth rate as well. So I talked a little bit about sell-side equity research at the start of the class. And if you remember sell-side equity research, you're given 15 companies in a sector. And all you do for the rest of your life is you track these 15 companies. So you look at Adam Jonas, who works at Morgan Stanley. He's been tracking Tesla since 2010. His life is built around 8 or 9 automobile companies. That's all he does. And much of the time analysts spend on these companies is not in valuing the companies, but in forecasting earnings. That's all they do, earnings per share in the next quarter, the next year. They're trying to get ahead of the market. So if I can get my earnings per share forecast a little better than the typical investor, I can make money on the next earnings report. So these analysts spend a lot of time with these companies, and presumably they also spend a lot of time forecasting growth of these companies. They might even have access to information that you and I don't, though the SEC kind of looks down on companies. But let's face it, they might get access to management that we don't. So you'd expect them to be pretty good at forecasting earnings growth, right? This is all they do. So I'm going to start with a pretty depressing statistic about how good analysts are at forecasting earnings growth. This is actually from 3 different studies, and all 3 studies, here's what they do. They compare the analyst forecast error. So the lower the forecast error, the more precise your forecasts are, to what you'd get by forecasting just using time series, historical data. So if you look at the first study, analyst forecast error was 31.7%. So they were off by about, on average, 31.7%. If you do time series model, you're off by 34.1%. So basically, you got a savings of 2.4% in standard error by paying tens of millions of dollars to equity research analysts to forecast the earnings. That doesn't look like much of a payoff. In fact, the other 2 studies indicate the same thing. Analyst forecasts are a little more precise than just using historical data, but not by much. Okay? And in fact, it gets worse. Most of the savings you get in forecast error is in the next quarter's earnings. If you go to 1-year, 5-year forecasts, analyst forecasts are just almost, you can't even tell them apart from time series models. So that's where I'm going to start this. If they're spending all this time tracking companies and they're spending much of that time forecasting earnings, how come their growth estimates are not much better than using this historical data and forecasting? What do you think analysts do or don't do that's leading to this very strange conclusion? They also rely heavily on historical data. You'd say, why not? They have access to management, but the SEC has cut that off, especially in the US. They might be biased upwards because you want to give, so they, even if you think bad things. No, I presented this to, sell-side equity research analysts about 10 years ago as a group. They didn't like this. And this was in New York. And they all looked at each other and they said, it wasn't us. It was, there are all these substandard equity research analysts. They work in Miami, they work in Chicago, they don't work in New York. In fact, their point was this is across all sell-side. Maybe if we pick the best of the sell-side equity research analysts, we'd get better results. Is there a way I can find out who the best of the sell-side equity research analysts are? You heard of All-America teams, right? In the college football, NFL. There's actually an All-America equity research analyst group the institutional investor picks every year. This is the pinnacle of your life. If you're a sell-side equity research analyst, if you make this All-America team, it increases your earnings power by about 50% almost instantaneously. So I said, you're right. I'm picking all these average substandard analysts. Why not focus on the All-America analysts? They're the best of the group. Their forecast error should be much smaller, right? So I took a look at them and I noticed something strange. In the year before they became All-America analysts, their forecast error was actually bigger than the forecast error of the typical analyst. So clearly, whatever process they're using for picking these All-America analysts, it's nothing to do with how good are you at forecasting earnings. But something magical seemed to happen the year after they became All-America analysts. Their forecast error became much smaller than the average analyst. So what do you think happened? Self-esteem went up because they got picked as All-America analysts? What happens when you become an All-America analyst that makes you a better forecaster? That affects the stock price effect. But your earnings forecast is a different issue, right? You're actually getting better at forecasting. So I can understand why your effect on markets gets larger. Why would your forecast get much better? Yes. Or they listen to you more, they leak more to you. So in fact, when equity research analysts become All-America analysts, it becomes part of their name. So you're no longer John Brown, you're John Brown, All-America analyst. Everywhere you go, even to your kid's birthday party, you say, I'm John Brown, All-America analyst. So when you call the company and say, I'm John Brown, All-America analyst, suddenly people pick up the phone and they actually talk to you. So you actually end up predicting earnings a little better because you get more information you otherwise wouldn't have. You have a much bigger impact on the price because when CNBC reports, and if you don't believe me, watch CNBC. So All-America analyst Adam Jonas has just increased his forecast for Tesla earnings. It seems to add to your following and how many people act based on you. So the price effect you have is greater. But it turns out that buy recommendations have a much shorter lasting power than sell recommendations. In other words, buy recommendations, the price goes up. Sell recommendations, the price goes down, which makes sense. But the price increase after buy recommendation seems to fade pretty quickly, but sell recommendations, the price drops and stays down. That's a bias issue, right? Which is if you're biased, people look at the buy recommendations, say that's good, but we know they're biased upwards. But sell recommendations clearly cut against traditional bias. So you tend to see prices drop and stay lower for longer. Now, I can't even count how many students of mine have become sell-side equity research analysts in spite of all of my attempts to talk them out of this. Now, at least 3 of the investment banks have equity research departments headed by students of mine. I try to still talk them out of it, but they're too stuck, they can't move. So I've wrestled with why is it that we spend so much money on sell-side equity research and get so little in return, right? All this money is not turning into a better earnings forecast. The buy recommendations and sell recommendations are pretty crappy. They sell a little better, but you know what? There's only 1 in 9 recommendations. That's a sell recommendation. So here are the 5 problems I think bedevil sell-side equity research analysts, and none of them is easily fixable. The first is tunnel vision. What does a sell-side analyst do? You're given a sector, the media sector, and you follow 15 media companies. That's all you do. The rest of the market doesn't even exist for you. You're so focused on your companies, you don't even look at the rest of the market. That's the tunnel vision. If all 15 of your companies go up, because that's all you see, you don't realize they've gone up too much So you're tracking all AI companies are all going up. This is the way the world works. If you're tracking airlines, they all go down. This is the way. So the tunnel vision is almost built into the way we do sell-side equity research. So if you were redesigning sell-side equity research, how would you fix the tunnel vision? Move people across sectors, right? Not only will it reduce tunnel vision, but it'll also reduce bias. Of course, you give up some expertise of being in the same sector. So something to think about, more sector rotation, more working across sectors, at least work with equity research analysts in other sectors and talk about pricing across sectors. The second is Lemmingitis. We talked about what drives sell-side equity research analysts. They look at management. You know what else they look at? Other analysts tracking the company. The next time you see an analyst raise earnings for NVIDIA, you'll see a rush of other analysts also raising earnings at the same time. You don't want to be left behind. You're following the crowd. Remember the Lemmings cartoon I showed you? Equity research analysts turn upbeat. In fact, one of the strangest phenomena is, equity research analysts don't value companies, but they put a target price, which is the pricing of companies. And the target price tracks the actual price. So everybody's raising target price for NVIDIA, not because they've revalued NVIDIA, but because NVIDIA's stock price is up. A lot of Lemmingitis, everybody trying to be on the same page. The third is a version of the Stockholm Syndrome. You heard of the Stockholm Syndrome? What is the Stockholm Syndrome? Or, the Patty Hearst classic example, got kidnapped, and before you know it, you're identifying with the kidnapper rather than the people trying to rescue you. You're saying, what's that got to do with sell-side equity research? The way I think about equity research is your job is to ask tough questions of the company and try to extract information and decide whether the company is undervalued or overvalued. But somewhere along the way, many equity research analysts seem to think it's their job to protect the company against shareholders. You notice this especially with companies like Tesla, where equity research analysts are actually more bullish on the company than the company's own management are. And they will actually fight to the death if you talk about the company not being a good company. You've forgotten what your original role was. You got Stockholm Syndrome. The fourth is a lot of storytelling with no, I'm a fan of stories, but stories without numbers will lead you nowhere. Pick up an NVIDIA equity research report. I've read a few. It's astonishing how fairy tales are told without actually attaching them to numbers. And finally, and this is more of an issue outside the US than in the US now, is this Jekyll-Hyde problem, which is when you're an equity research analyst, you get no revenues for the company. So basically, the only way you get money as an investment bank is from people trading on equity research. But the investment bank also has other business with the same company. They're investment bankers, they're making deals. And sometimes equity research analysts play two roles. They're analyzing the company, at the same time, they're bringing in deals from the company. So you're the sell-side equity research analyst for Tesla, you're trying to convince Tesla to use Morgan Stanley. You have a very dangerous conflict of interest here as to whose interests are you putting ahead. In fact, this was at the heart of, remember Eliot Spitzer? He was governor of New York. He got caught in some you can look up Google search, Eliot Spitzer. You don't want to go there. But he made his name as Attorney General of New York by going after sell-side equity research analysts, specifically on this conflict of interest issue after the 2001, 2002 market, where he said, you need to tell your clients who you work for. What's your business? Is it to be a sell-side equity research analyst, or is it to be somebody who is a salesperson for the company? Because somewhere along the way, you seem to have lost that balance. So I'm pretty cynical about the future for sell-side equity research. If any of you are interested in sell-side equity research, better not to talk to me, because I'll probably try to talk you out of it, because I don't see the value added right now from sell-side equity research. There's no original ideas that are coming from sell-side equity research. There's too much Lemmingitis. There's a lot of tunnel vision, and not a whole lot of original research on companies that you're getting from sell-side equity research analysts that changes your perspective on the company. Some sell-side equity research analysts are better than others, and you can probably, as you look at multiple reports in your company, you can find those. It's amazing how low quality sell-side equity research is, at least collectively. So here are three general propositions about an analyst growth rates. It's a very marginal advantage because what are companies allowed to reveal to sell-side analysts without breaking the law? According to SEC, it can't be something material and data-driven. It can be some kind of a story, which is, oh, you know what, this product will do really well. So it's kind of the information they have is at the best very marginal information, because if you gave something specific, that would technically be breaking the law. And companies don't want to do that. Analysts don't want to do that. So the amount of information in the US that analysts have relative to the average investor is remarkably similar in terms of our information sets. It's different outside the US. In some parts of the world, equity research analysts have insider relationship with the company. So if you're in Asia, a sell-side equity research analyst can have a decided advantage over an average investor, because they can talk to the management can give them information, they can legally use that information, and you don't have access to the information. But in the US, I mean, it's almost nothing in a sell-side report you couldn't have found out on your own by typing in Google search. It's as bad as that in terms of information. So whatever information they get is very, very marginal, because we get past that, you got the SEC insider laws coming after you. Any other questions? So let me summarize our discussion of, and so let's say you looked at the historical growth for your company, you decide to use a little bit of it, not or none of it. You look up the analyst growth rate for your company, you come up with a number, look at that number, then let it go. What I mean by let it go is don't try to get your growth rate to converge on the analyst estimate of growth. And the reason for that is very simple. They're not that good at forecasting long-term growth. And they're forecasting growth well. They're forecasting earnings per share growth, and you want revenue growth. So historical growth, not that useful. Analyst growth, marginally useful, which leaves you with the third way of thinking about growth. And at least I want to get this process started because it is, I think, the healthiest way to think about growth, because it ties to your story and ties to your other assessments or estimates you're making for your company. It's called sustainable growth. And basically, it comes from looking at what a company does. So I'm going to set up a very simple hypothetical company. Let's assume a company with $1 billion invested in existing projects on which it makes a 12% return. So right now, its earnings are 12% of $1 billion, 120 million. Next year, it adds another 100 million in new projects and continues to make 12%. Just mathematically, its income next year is going to be 132 million. See, where's this going? If you look at the increase in earnings they got next year, it's coming from two things. How much are they reinvesting? Without the new projects, there would be no additional income. And what are they making on that new investment? It's at the heart of the sustainable growth view of growth, of estimating growth is, tell me what you're reinvesting, tell me how well you're reinvesting. And from those two questions, the answer to those two questions, I can assess what your future growth is going to be. Of course, I've kind of left it nebulous what I mean by investment and return on investment, and can take different forms, but that is at the heart of fundamental growth. But I'll tell you when it'll break down. If your margins are changing, this equation is no longer going to work. And here's why. If, let's say, instead of growing, so if my return on capital stays at 12%, which it did in that example, I can take what I'm reinvesting as a percentage of my earnings, it's called the reinvestment rate, and multiply it by my return on capital, and I get the growth rate, 10%. But if my margins are changing, my returns are changing, that equation no longer works, because you're now getting a second component of growth. Let's call it efficiency growth. You don't even have to reinvest. If your return on capital goes from 12% to 13%, the existing capital invested, your earnings are going to go up because you earned a higher return. So when your margins are stable, your returns are stable, the sustainable growth equation is a great way of thinking about growth. What kinds of companies have stable margins and stable returns of capital? In terms of the life cycle, what are we talking about? Mature companies, which are far enough away from decline, that you can say for the next 5 or 10 years, this company will continue to make 12% margins. Maybe a Coca-Cola, maybe a McDonald's, but even there may be, because who knows what the next 5 years will bring to both companies. So if your company is in steady state, it's mature, then the sustainable growth equation is a healthy way of thinking about growth, because it forces you to think about, what is my company doing? And of course, when you think about how you measure how much you reinvest, and this will be a last page for today, it depends on what you're trying to forecast growth in. If you're trying to forecast growth in earnings per share, I'm going to measure how much you reinvest with the retention ratio. What's a retention ratio? It's the inverse of a payout ratio. You know what a payout ratio is? Dividends divided by earnings is the payout ratio. If you have a payout ratio of 40%, your retention ratio is 60%. That measures how much you reinvest, and how well you reinvest, I measure with the return in equity. Why? Because earnings per share is an equity number. I'm looking at equity reinvestment, equity return. If I'm looking at growth in net income, not earnings per share, but growth in net income, my reinvestment will have to be a little more complex. I can't just look at the retention ratio. I'll have to compute how much the company is actually reinvesting back. Net capex, change in working capital, acquisitions. But I can use some debt to cover it up. So to the extent the amount of equity I have to reinvest becomes the numerator. It's called an equity reinvestment rate, but I'm looking at what I'm reinvesting back in the business. Let me pause right there. And I look at a retention ratio. What's the lowest number it can be? 0. What's the highest number it can be? 100%. But when I look at an equity reinvestment rate, I don't have that floor and ceiling. My equity reinvestment rate can be greater than 100% if I go out and raise fresh equity. It can be below 0% if I'm depleting or declining as a firm. So equity reinvestment rates are much more flexible to reflect very different kinds of companies. And when I measure how well you reinvest, I'm going to focus on the return on equity on my non-cash investments. What does that mean? Return on equity is net income divided by book equity, right? But if you look at a company like Apple, which has 160 billion in cash, the book equity is really not invested on operating assets. The big chunk is in cash. With non-cash return equity, I net out the interest income from cash from my net income, and I look at the book equity net of cash. So I'm looking at net income from operating assets. And if I look at operating income, I measure reinvestment, again, consistently. My reinvestment rate is the net capex, including all the acquisitions, R&D, et cetera, plus change in working capital, scaled to my after-tax operating income, because I'm focused on operating income. And the return I'm going to use is the return I'm going to earn on my overall capital. Just compare those three, and in a sense, you're going to see that I'm following the same rules of being consistent. If I focus on the equity route, everything has to be in equity terms. If I'm focusing on the entire business, everything has to be in terms of return on capital, reinvestment rate has to be in terms of the whole business. So next class, after the quiz, I'm going to talk about doing this for your company. So if you at least have a sense, if you've not picked a company, do so now. Now, if you've picked a company, at least start to think about making these estimates going forward, because that's what's going to drive your value as a company. I will see you first 30 minutes of the class will be the quiz on Wednesday, so try not to be late. Jake has, I think, an announcement to make.
Mike work, Professor. Yeah. Okay, guys. There will maybe be a review session tomorrow that me and Deep will host. It's all contingent on if we get a room or not. But please check the announcements up until the last minute tomorrow, guys, because we will try and hold a review session for you. All